Welcome to the When It Matters podcast by Mesh. Today we're joined by the amazing Aarish from Emerge One and Nothing Ventured podcast, which is going to be a fantastic session today. You've been a fractional CFO, a CFO, helping some amazing companies from Playfair, I think Hoxton, and some other venture-backed businesses. So I'm really excited for our session today.
Yeah, no,
So welcome.
thanks. Yeah, thanks for inviting me. Really glad to be here.
Amazing. So you have a kind of a tagline on your LinkedIn, "Stay liquid." What does that mean?
That actually came out of that time we all want to forget. So back in 2020, during COVID, and then actually 1 or 2 years later, when SVB went through its collapse, as you can imagine, lots of startups were in panic mode,
Mhm.
like, is their cash secure, et cetera, et cetera. And I, alongside a couple of VCs that I know, started kind of putting together a bit of a sort of roster of liquidity providers, so capital providers, debt and equity, et cetera, but also law firms and accountants and people that you could go to if you needed a hand, given the kind of trauma that a lot of people are going through. And yeah, Stay Liquid kind of came out of that because, the one thing you need in business is liquidity. If you don't have it, you're probably not far off from dying. And I just liked it as a little bit of a catchphrase. It's not something I use all the time, but yeah, I think when you're going through kind of pain points, it's good to have that at the back of your mind. Always stay liquid.
Okay, amazing. All right, so let's talk about a scenario. So let's start with the kind of the dream scenario. You're a seed stage company. You've just raised £3 million. Everyone's excited. The money hits the bank on the Monday. All the paperwork signed. What's the first thing they should do from a finance perspective?
uh, I'm going to answer it in a self-serving way, and I'll answer it in a less self-serving way. So, um, assuming this is your kind of first institutional round you've raised from, say, VCs as opposed to from angels, which is typically kind of the progression in the UK. Certainly you start off raising from angels, maybe 500,000 up to 1 million, and then progress. And if you're seeing the traction and the ability to raise from institutional, go out and raise from a venture capital kind of provider. If you're raising 3 million, that's it's a decent sized seed round. In the US, that's probably closer to $10 million or something. But in the UK, that's a decent sized seed round. Most founders, have not managed a P&L, have not managed cash to that extent, right? I would argue, most have not managed anywhere near sort of seven figures worth of capital. So having 3 million hit your bank account, it can be incredibly inspiring, incredibly, uplifting, but it also comes with a lot of weight, right? You're now responsible for that capital. You're responsible to your shareholders, your investors, to manage that cash well, and to manage a relationship with those investors well, and to do as much as you can to grow so that at some point in the future you'll be able to return that and much more, one would hope, capital back to those investors. So really the first thing I would do is hire a fractional CFO, right? And I know that sounds self-serving, and it's not intended to be, but the reality is that too many founders get caught in messes because they don't have the right people who understand how to manage capital efficiently and effectively. And they don't have sort of people in their corner that are not only sort of maximizing their use of their capital, but also minimizing the waste, right? I mean, a CFO does many, many different things, but first and foremost, a CFO is all about capital management. Like that's what they're there. They're not accountants, right? They're not there to manage the books. They're not there to do the bookkeeping. They are there to manage the capital, and that's kind of the distinction that I think a lot of people don't get, certainly here in the UK. If I were to drill down into that further, right, from the perspective of either me as a CFO or as a founder, as I have been, or even if I was just giving some friendly advice, right? The first thing I would do is plan, right? So
Yeah.
you've got 3 million. How are you going to spend it? What are you going to spend it on, and why, right? And I think the most critical question there is the why. What are the assumptions behind your spend, right? Which is why often, certainly when a fractional CFO comes into a business, one of the first things they'll do is build out a financial model, forecast, there's an old saying, all forecasts are wrong, but some are useful. It's actually all models are wrong, some are useful. And that's reality, right? Because you can forecast everything based on the assumptions you have today. Those assumptions can quickly change. They may change in 6 months' time or in 12 months' time, but they will change. I can almost guarantee you that at seed, as you are searching for kind of product market fit. So having a plan in place is better than not having a plan in place, because that will tell you, okay, if I hire 5 people, what's that going to do to my runway, right? As in how much cash I have available to me and over what period of time is that going to last? It'll help figure out, okay, if I'm expecting revenue to come in, what does that do to the business cash profile, and what happens if that slips, or what happens if that accelerates, right? Does that mean I can then go out and spend more on hiring or potential marketing or whatever else it is, right? So the first thing is build out the plan, right? The second thing, when that cash hits the bank, ensure that you have sort of basic financial hygiene in place. And what I mean by that is make sure you understand how to track and account for the money that you're spending. That means getting good accountants or good bookkeepers in place that can manage your books, so that you can understand very clearly how the business is tracked over time, right? The third thing I would do is set up reporting, and I don't mean reporting in terms of just pure financial reporting, right? Management accounts, all that sort of stuff. Yes, you should do that. What I actually mean is you have an obligation to your investors. You need to be telling them what you are doing. Now, a lot of people think that means I'll just tell them when, we've got a new client, or revenue's doubled, or, all the good stuff that we all love, as founders and as people within the startup ecosystem. But actually, it's just as important to tell investors about where things aren't working and why they aren't working and what you are doing to fix them, for a couple of reasons. The first reason is sometimes those investors can help, right? We all know the meme, the how can I be helpful meme around VCs. Reality is actually most VCs can be incredibly helpful, right? They may be able to open doors to potential customers. They may be able to help you hire the right people, whether that's commercial, whether that's maybe a chair for your board, maybe that's an engineer, whatever the role. But they've seen this. There's some pattern recognition going on, which will help them either open the door or help you make the right decision once you think you found the right person, right? But the second reason is, I had this with the startup that I tried to build, right? I ended up closing it down. It, finally wound it up earlier this year. But one of the comments I got back from a number of the investors, some of whom are VCs, albeit that they invested in their personal capacities, they said, "We know you didn't waste that money. You were telling us month on month what was going on, what was working, what wasn't working. None of this came as a shock or surprise. And I'm confident that you use my capital to the best of your ability to achieve what you could, right, within the boundaries of that capital."
Yeah.
So reporting, making sure there is a clear line of communication between you, your investors, you and your board. If you haven't got a board, when you raise the seed, certainly like 7-figure seed, you probably want to get a board in place. That's going to normally consist of, you as the founder, possibly your co-founder, maybe one other person from the team. If you don't have a co-founder, it's probably going to include an investor director. So, if an institution has put in, say, $1 million of that, 3 million, then the likelihood is they're going to ask for a board seat. And you may have someone external, non-exec, someone along those lines. Now, again, you don't want to get tied up in governance. This is not about, ticking every sort of every box, in the, in the Companies Act. This is about good governance, direction. It's about having people that can steer you in the right direction. If you're a young founder, especially, and you haven't done this before, why not take the lessons that others have been, have essentially almost certainly failed and learned from, and use that as part of your decision-making process. And that's what really great boards are there for. They're not there to kind of sit there and just report back the numbers. They're there to help you figure out, okay, how do I go from A to B? How do I get to the next milestone? I did a great podcast with Fred Destin from Stride Ventures. He talked through what good and bad looks like on a board, and where his gaps are, and how he thinks about being a strong supporter to the founders that he's working with. So I think these are all really important things. Um, uh, and I guess to tie off the question, what would I do? First thing I would do, I would make sure I know what my objectives are, right? And that goes back to the planning point. Where am I trying to get to? How do I think I'm going to get there? And then start executing. And within that execution, make sure you're learning, right? So every time you execute, you should have a feedback loop that tells you whether something is working, not working, and how you need to course correct, or whether you need to course correct in order to start moving in the right direction, or potentially even in a completely different direction, depending on what the data is telling you.
Amazing. So yeah, so get a good board in place, get a CFO in place, reporting and governance back to your investors, and making sure you're forecasting and planning so you know where the money's going to be going to. Okay.
100%.
Wicked. Some really, really good advice there, and don't buy a really expensive coffee machine, potentially.
Well, it depends. Like if coffee is going to help you execute better, then, have at it.
Then maybe. Perfect. Okay, I was listening to one of your other podcasts yesterday, and I want to go back to Papua New Guinea,
Oh.
where you were, and apparently one of your factories burnt to the ground, which kind of scuppered a lot of things. Firstly, with obviously Mesh being a insurance broker, I wanted to know, firstly, were you insured, and kind of walk us through that story?
Yeah, it's probably the most difficult period I've ever been through. So the backstory, I guess, for people who won't know this, and I'm sure a lot of people won't know this. So Papua New Guinea is an island nation to the north of Australia. It is pretty remote. It was, only quote unquote discovered, I guess, in the 1900s. Was then under British rule, and then under Australian rule to some extent, and then gained independence in the 70s. And it's kind of a real frontier economy. It's massive, has massive mineral and natural resource wealth, incredible climate in terms of agriculture. So really some amazing things going for it. At the time I was there, I was running two factories or two businesses with multiple manufacturing operations alongside a trading business. And, we were involved in the manufacture of polyurethane foam and furniture products in one of those. And in the other one, we were manufacturing packaging products. So flexible packaging. So essentially plastics for use in FMCG or industrial settings, right? So for agriculture or for building and construction and so on. So one of those factories, we were also recycling material. But Papua New Guinea is a country with its fair share of problems. One of those problems has historically been inadequate or flaky power supply. So you see a lot of brownouts, blackouts, grayouts, etc. And what had happened was I would be spending at that time probably 2 or 3 weeks out in Papua New Guinea, and then heading back to Melbourne for a week or two to spend with my wife and my daughters. And I had literally got off the plane, had come home into the house, was about to get into bed quite late in the evening, and I got a call. And the call was from one of my sales guys in Lae, which is the sort of industrial hub in New Guinea. And he just said, "Boss, the factory's burning." I said, "What are you talking about? Like I don't need this at like whatever midnight on a Friday night where I'm just got back to my family." And then he sent me some pictures and some videos, and yeah, the factory was literally burning.
Wow.
Burning to the ground. So within the next sort of 24 hours, I flew back out. It's quite difficult to get there. It takes about a day to get there, depending on where you are. So I arrived, I think from memory, on a Sunday evening, and it was still burning. Like fires were still lit, stuff was still up, right? I mean, there's no fire well, I mean, there is a fire service, but it's fairly sort of small scale, lightweight in comparison to a lot of other places. So here I am, factory's burnt, and obviously, first thought process was, right, have we paid our premiums? Are we up to date? Fortunately, we had some really great brokers, and they worked through this all with us, so we were insured. And over the course of the next, I want to say 6 months, it may have even been longer, we went through a huge amount of stuff. So the first thing I did was I brought in a loss adjuster, risk adjuster from Brisbane, who could help us sort of work out, okay, what are we going to present back to the insurers in terms of what the claim is, work through the business interruption side of things, all of that sort of stuff. There was also some really awful stuff. We had to let go of almost all of our staff because we couldn't manufacture anything. We had to work with our clients and our suppliers to make sure that they understood what was happening and gave us the room that we needed. We worked with our competitors, right, to fill some of our orders, to provide some materials that we were able to supply our clients, etc. So there's a whole raft of stuff going on, but obviously the biggest part of this was the insurance piece, and okay, how do we work through that? So again, as I say, between our brokers and the risk adjuster, loss adjuster that we brought on board, we were able to come out of it incredibly well. I would say. So typically, as you will know, but a lot of people won't know, in these sort of situations where you have equipment loss, which is what we had equipment loss, we had raw material loss, we had finished goods loss, we had damage to our buildings, our warehouse, and our factory. What most insurers will do is settle you based on a replacement cost basis. In fact, they won't even necessarily do that. They will potentially just replace the equipment that you had. So essentially what they're aiming to do is say, okay, you're insured, you lost your equipment. Okay, we're just going to reinstate that equipment so you can just get going again. We made some very strong arguments why that wouldn't make sense, right? Whether it was because that equipment was not replaceable to some extent, right? Not that it was irreplaceable. That's the wrong way of looking at it. But we would have had to significantly upgrade. So actually replacing it with like for like just didn't make sense, right? It was old equipment. Some of it was not available on the market. You'd have had to look at some completely different kit. So by the end of this process, we managed to come to an agreement with the insurers to give us a full cash settlement. And that was just an incredible moment because with that full cash settlement, we were able to essentially restructure the entire business, move it from manufacturing into a trading setup where we were importing and wholesaling product from Southeast Asia, China, Malaysia, Indonesia, etc. We were able to, make good on our staff. We were able to consolidate onto one of our other sites. We were able to return some capital back to shareholders. So there was a whole raft of things that we were able to do with a full cash settlement, which, had we have had replacement, that just wouldn't have happened. So yeah, I mean, look, insurance is never something you want to have to draw upon. It's painful because you are essentially you're paying a premium to hedge against the risk of something happening. So it feels like you're just sending money into nothing. But hey, when the proverbial hits a fan, you're pretty happy that you had it. And by the way, right around this period, I think it was like a month or two after this happened. This was, this was a business that had ties to other businesses in other parts of the world, and one of the sort of, let's call it a sister business in Canada, literally had a fire. I think they call it a 3-bell fire, like pretty much the worst you can have. That just destroyed their entire operation in Canada. So it was really incredible to us, and we know each other very well. He's actually a cousin of mine. We were going through this all at the same time. So obviously compared notes, but make sure you're insured. Like, honestly speaking, you don't want the worst to happen, but if for any reason it does, you don't want to be caught with your pants down, for sure.
No, definitely not. And it's good to hear that you had some good support from your brokers there to help you with 100%, with that settlement, because it's really important. And then going back to kind of the reporting, the communication stuff you were talking before, how was that we'll go back to Melbourne and back to Australia? How did they find this whole situation?
So it's interesting. So our shareholders were relatively remote.
Okay.
But we had a board. We were in close comms all the time. We were reporting back to shareholders what the situation was and what the likely outcome was going to be, and so on and so forth. But yeah, I mean, it's just open, honest communication. Look, these are the challenges. This is the conversation we're having with our insurers. This is the conversation we're having with the team. This is the conversation we're having with the banks, the financiers, all the people that that go into making a business, certainly a manufacturing business, where, again, as I say, suppliers. We had suppliers like ExxonMobil, right? They're not a small company, as I think most people understand. If you've got product that they'd shipped you which you haven't paid for, and all of a sudden you can't pay for it, like, you need to have conversations. But we were really lucky in that over the time that I'd been there, which by this stage is probably about 7-8 years, I'd built very strong rapport and relationships with all the stakeholders across, like, the entire business. And as I say, that's everything from suppliers to competitors to clients to shareholders, et cetera, et cetera. And yeah, you've just got to take it in your stride. I mean, the worst thing you can do is just panic, right? Like, and I was a lot younger then. This is over 10 years ago now, coming up probably close to 15 years probably. And you don't know how you're going to deal with those situations when they happen. All you can hope to do is deal with them as best as you can. But the learnings and the lessons, etc., have stayed with me, for a long time since.
Amazing. No, such a fascinating story. So thank you for that. The next bit I really want to touch on is flying blind. So you kind of say that you help founders to not fly blind. What does flying blind actually look like for a startup, and what's some of the kind of common pitfalls that you've seen founders make?
Yeah, so again, it comes back to what I said right at the top, right? If you don't have a forecast, if you don't, so there are two things, right? So you have operational finance, you have strategic finance. Operational finance looks inwards and backwards. It tells you what the business has done, and it does that by reporting the numbers that you have achieved, right? So that's your management accounts, that's your bookkeeping, that's your accounting, right? And then strategic finance is about looking outwards and forwards, right? What's happening in the market? What's happening with the competition? What's happening with our clients, right? How do we maximize our growth and our standing in the market? And what flying blind is when you don't have any of that, right? So you don't know how you've performed and you don't know how you're going to perform. And what are the things that you can do to resolve that? You can put in, KPI tracking. You can understand what the key metrics are in your business. You can look at your unit economics and understand, okay, is this sale profitable? Is it costing me more to acquire a customer than it is to, in terms of value creation, to retain them? So you put in place all of that reporting structure, which isn't reporting for the sake of reporting, right? So I often see founders who will try and track everything, right? So they'll want to track. And by the way, revenue is never a KPI. Revenue is the outcome from a KPI, right? So, but they'll try and track everything, or they'll try and track everything that they've seen other people say that they will track, right? And that's why, when you bring in a CFO or a fractional CFO, like someone from our team, or even myself for that matter, we don't look at, okay, what are the standard KPIs? We look at the business, we understand, okay, what is essential for this business to track? What is that core metric that tells us we're doing well? I'll give you a great example. There was a business that I worked with, which was, they would call themselves charity tech. Essentially, they were a SaaS business that was selling software to universities, higher education institutions, some private schools, to manage their giving days, which are basically where alumni come and donate, right? So, if you want the Jake Wells auditorium at your alma mater, right, you'll go in and you'll donate $500,000 or whatever, and do that. Now, often that happens off platform, but this is where, as an alumni, you can donate 5, 10, 15, 100, whatever the number is, pounds to your university or whatever. And so for them, the metric was actually not financial in the tradition. It wasn't financial within the business. It was financial outside. So it was how much. So there were two actually. How many donors have come onto the platform, and what is the total quantum of cash raised. Now, that has zero impact directly on the business, right? The business did not make money out of the volume of donors or the volume of cash that was donated on the platform. It was a pure SaaS play. So, you pay a subscription, have the product, it's implemented and all the rest of it. But what those metrics told them was how well the platform was doing in terms of adoption, both by the universities that they were selling into, but also the ultimate end users of the platform were the people donating. And if you're seeing that those numbers are growing, then you know that you have a product and a platform that is getting stickier, and you can start thinking about what you do with that data, right? And part of what you do with that data is go to other potential clients and say, hey, we've increased the number of donors on platform by X for this customer. We could do the same for you. So that's one sort of thought process around kind of KPIs and what it means to fly blind versus not flying blind. The other thing, is founders, when you're at seed especially, right, you do not have data. You have belief, a vision, hopefully some cash in your pocket, or in your bank balance rather than your pocket maybe. You have a couple of team members, a few team members, and you have the makings of a product, and maybe you have some early traction, right? Flying blind is what I've seen in other companies, for example, where a founder will just go out and run 300 pilots because pilot feels like productivity. But without learning anything from those pilots, you aren't actually taking the business forward, right? So again, it comes back to those feedback loops. So flying blind is doing stuff without having the systems and processes in place that allow you to take the learnings and help you to inform your product or your strategy, your go-to-market, et cetera, et cetera. So it's about structure to some extent, right? Now, and I think one of the things that all of us who work with startups love, those of us that have the bug, it is somewhat that chaos, right? But that chaos is organized chaos, right? Now, very early stage, pre-seed, pre-product, pre-everything, you can afford to be slightly chaotic, right? Like you're learning stuff off the hoof, on the fly, just constantly, right? You're trying new things all the time. By the time you've gotten to seed and approaching Series A, right, you need to have something more than just,
Vibes.
we'll try this, and the vibes are gonna inform us. You need to start putting a little bit of structure in place. For example, right, one of the things that I've talked about previously is chaos is great when you have a few employees. When you have more than a few employees, and it's certainly when you have more junior employees, structure really helps them because it helps them figure out how they should be operating within the parameters of what their role is. If you just leave it open-ended, then you can have a marketing person that's just doing everything, but not actually doing anything, right? Like, okay, we're going to create 100 blogs, or we're going to set up a podcast, or we're going to, start using Google Ads or Facebook or whatever. But without any defined criteria for why they should be doing that and what output you're expecting from it, you're flying blind again, right? So it's about structuring your thinking and your business in a way that you are constantly getting feedback from these various feedback loops so that you can better maneuver the business and drive it in the direction that you want it to go. Look, equally, no founder flies completely blind, right? Like founders typically are pretty smart people, who have gotten where they have gotten because they've done some things right. So, they will know that they need to be looking at a lot of this stuff. The problem actually is not about whether they know or not. It's more that they don't have the time to do it, right? Because, as a founder, you are pulled in 101 different directions. You've got to manage the product, you've got to manage the team, you've got to manage the go-to-market, you've got to manage the clients, you've got to manage, the bugs, you've got to manage, the dev, all of that stuff. Do you have time to then think about, okay, how should I be reporting, et cetera, et cetera? Probably not, right? Like it becomes tough. And so we often see with founders, especially when they bring on teams like ours, it's about the overwhelm. It's about, I know I need to be doing this. I just don't have the bandwidth to do it, right? So it's less about not knowing and therefore flying blind. It's flying blind because you just don't have the time to set up the process and the systems that you need.
No, 100%. I even feel like myself is in that current moment now, and we're starting to track some stuff. So for look, we've raised 950K. We're pre-seed. We're going to be going out for our seed round soon. what kind of metrics should we be looking to track? Because yes, it is absolutely overwhelming at start. Yes, we've got the podcast, so then we're tracking how many views we get. We're tracking what does that come from.
I wouldn't bother. Like it's like tracking podcast metrics is like the least worthwhile endeavor that you can embark on. No, look, I mean, as you move from pre-seed to seed, right? Again, it's about pre-seed. It's all about finding a pain point, and exploiting that pain point, right? Whether that's via a product or a service. When you're raising seed, it's about, okay, we found the pain point, we've got early traction, we now need to see whether we can ramp that up, right? So at seed, no one is expecting you to be doing $1 million in revenue, right? No one is expecting you to have everything figured out. What they are expecting, though, is that you have a product in the market which has early signs of some traction. Now, what a lot of people get wrong is, does traction equal revenue? Not necessarily. Traction could be users. Traction could be podcast views if that is core to your engine. But more often than not, traction is going to be something along the lines of users or pilots done, or partnerships, deals, et cetera, right? And that's what you're going to be showing at seed, right? The other thing you're going to show at seed is that you can build a business, right? Not just a product. And I think this is what a lot of founders get wrong about venture. Yes, venture obviously is backing ambitious people doing ambitious things. But I always remember, this conversation I had with one VC around a founder that that he'd introduced us to. He goes, this guy is absolutely amazing at building sales, but he doesn't know how to build a business, right? Because if you don't build the business, if you don't build the infrastructure that scales as the product scales, as the sales scale, then something will come unstuck really quickly. So at seed, I'd be focused on, does the narrative make sense? Is the market big enough? Like, it's all the usual stuff. Is there a big market? Can we execute? How can we prove we've executed? And how can we prove we can get to the 1 million, 2 million, 3 million, right? The old kind of, I wouldn't even say old, but the thinking around SaaS especially was, triple, double, right? So essentially you want to be tripling your revenue in your first couple of years, doubling in the next 3, because from a base of 1 million, if you do the maths, over 5 years, that gets you to 100 million.
Yeah.
Right? Investors want to see a pathway to that outcome. The other thing, and I cannot say this enough, right? Not every business is set up for venture capital. Not every business should raise venture capital, right? Some businesses, there are other financing opportunities out there, or bootstrapping, and you should consider those. If you are raising from venture, you are making the implicit, if not explicit, statement that you believe you can grow this business to a substantial enough size that it can, on exit, return the fund to a venture investor. What does that mean, right? What does that mean? Let's do some simple maths, right? And very simple. It's far more complicated than this, right? But let's say you're $100 million venture fund, right? And you're investing at seed, and you invest $1 million for 10% in the business, let's say, right? So $1 million at 10% means that the business is valued at 10 million.
Yeah.
Okay, great. If you as a business need to return their fund as a minimum, that means as an exit value for that investor, you need to return $100 million. Okay. Yeah. Let's assume that you don't raise any further investment. So that investor remains at 10% on your cap table.
So no more dilution.
No more dilution. In order to exit and return $100 million to that VC, you need to be valued at $1 billion at exit. It's as simple as that. That's venture maths, right? They aren't looking for the 50 million, the 100 million, the 200 million. Now, they may well have some of those exits in their portfolio. And I would always argue there's nothing wrong with those exits, but venture is a power law game. They are aiming for outlier businesses that can return huge amounts of capital back to them and their LPs, the investors in their funds, right? So as a founder, you need to be prepared that I've got to somehow over the course of the next 5 to 10 years, get my business to $1 billion valuation, which likely means round numbers, 100 million in sales plus, and I've got to do it quickly, and I've got to find someone that I can exit that business to, either because they'll acquire me or because I'm going to IPO, right? Because at some point you have to return that capital back to investors. That's why they've invested. And not only do you have to have the mindset that that is what you are aiming to do, you gotta have the grit, determination, resilience to get there, because it ain't easy, right? Like, it is not a simple endeavor to go from at seed, a product, an idea, and some early traction to like, but this is how we're going to get to a $1 billion outcome, right? And there's a lot of fantasy that obviously pervades a lot of founders, founder minds. But there's a stat that who was it? Joe Knowles from Smedvig Ventures told me on my podcast a few weeks ago, right? Over the last 15 years, 15,000 companies have received venture funding in Europe.
Okay.
That is only 1,000 businesses a year across the whole of Europe receiving venture. Yeah. Of the 600 billion of realized value, and I think that equated to, I think it was like 150 companies or something like that. I think 40 odd % of them equated to accounted for 80% of that value realized. So the numbers are vanishingly small, right? Yeah. The businesses that get to $1 billion are few and far between. So when you raise venture, you are making that explicit statement that I believe that we can get to that outcome, and many businesses won't. 100%. And the pain of not getting to that $1 billion outcome can be really, really strong and difficult to internalize. And a lot of founders feel really washed out when it doesn't go their way. But I'm here to say that's okay, right? Like, that is the nature of venture. And if you're a founder that has done everything in their power, and this goes back to what I'm saying about, telling your investors how you're spending, where the problems are, what's going right, what's going wrong. If you have done everything in your power to make it work, good on you. Yeah. Like, you can be proud of that. If you don't get to the $1 billion outcome, okay, that's the way the chips fell this time. Maybe next time will be different. Maybe you won't do it next time, but that's the nature of the game.
So do you think it's important for founders then, if they are going on the VC route, to be asking the question of what is the fund size, and to understand, are they going to need $1 billion to return that? Or you may be speaking to a smaller fund, a newer fund that's just on fund one, for example, and they've maybe raised 30, 40, 50 million.
You should always understand your investor. 100%. You should understand what they invest in, why they invest, what stage they invest, how much they can invest, what their check size is, who else is in their portfolio, how do they work with founders. There are a huge number of reasons to do your diligence on an investor, right? As a founder, right? So from a founder's perspective, you want to understand. So again, the average venture-backed business, the relationship between the investor and the founder lasts more than the average UK marriage. Right. So you are in this together for a period of time, right? And it's likely to be 10 to 15 years, right? That's, you will see, I think the stats that I had on this are slightly outdated, but the average time to exit a business is anywhere between 9 and 13 years, right? So you are going to be in it for the long haul. So you want to make sure that whoever is on your cap table is someone that you enjoy working with, especially if they're then going to be on your board, which at the early stages is less likely, but the later on you go, for sure. Yes, you should understand fund dynamics. You should understand, what stage of the fund they're at, right? Because if they've been investing for the last 5-6 years, then probably over the next couple of years, unlikely they're going to be investing in fresh deals. But let's say they are, they're probably going to start needing to return capital back to their LPs, which means that they are looking for those exits in their portfolio. So, if you come in year 4, for example, you're going to be right at the tail end of their investment cycle, which means in the next 3 or 4 years, they're going to be looking for returns, right? If you come in right at the beginning, if you're the first check they write, okay, maybe you've got 7, 8, 9 years, right? So understand that. Understand the fund size for sure. with early stage funds, remember that their exits don't necessarily come from an exit or an IPO. They may be able to sell their shares as secondary, right? So if someone comes in at Series B, like, okay, we've got all these early investors in, we've got some employees, etc. We want to get them off the cap table, give them some liquidity. Then they may do a secondary round, which means there's no fresh capital issue. That they're just buying the shareholdings of existing shareholders. Whereas a primary financing is where they are introducing fresh capital into the business, right?
Yeah.
So what happens there is that those early investors are probably going to make a 4x, 10x, maybe 15x, maybe 20x, doesn't, it depends, return on their initial capital. And that may well be, good enough for them, right? Because if you're writing a $500,000 check in a 10 million fund and you get a 20x return, that's your fund return.
Yeah.
Yeah.
Okay, amazing. And on exits, I think you've been through an exit yourself as a CFO, is that correct?
So no, personally, I haven't, sadly. We have taken other companies through exits, and companies that I have worked with have gone on to exit. One went on to exit for $300 million odd. One we took through a $150 million exit from very low sort of revenue base at the time. I as a CFO, I love seeing companies achieve the things that they set out to achieve. I don't think an exit is always necessarily the only thing that you should focus on. But if you are able to sell your business or trade your business as a listing, I can only imagine how kind of how amazing that feeling is. But I think we all get caught up in the exit. You got to build the business first.
100%.
Right?
But do you think that, because obviously the VC route, they're only getting in to get out at some point. So
Yeah.
I find it quite conflicting when you hear from like VCs, they say, oh, don't be thinking about exit. Obviously they want you to focus on the business and build the best business possible. But the only reason they gave you the money in the first place was for at some point them to exit.
Yeah. So one of my investors, he said the minute you take capital from anyone, so think about it, because the minute you take capital from someone outside, the clock is ticking on an exit. And that by the way, that exit might mean business closes. It might mean that you are sufficiently cash generative that you can have dividend flow going back to those investors. That's another form of return. Or that you sell the business or you IPO the business, right? All of those are potential sort of exits, right? We use exit as a very, very broad term. We use exit very specifically in the world of venture, but actually there could be broad applications. I don't think it's disingenuous, because I think everyone who gets into venture understands that is, or should understand that is the nature of the game. What a VC is basically telling you is, don't focus on the exit today because you've got to do all these things to get there. At the appropriate time, when it is time to look at that exit, we'll be in your corner, hopefully making sure that happens in exactly the way that it needs to happen. So no, I don't think it's disingenuous. Founders have enough problems to worry about without sort of thinking, I'm in year 3 of this business, I've got to think about an exit in 7 years. And by the way, businesses, your exit never comes from necessarily the place that you thought it was going to come from, especially if it's a trade sale, right? Like in the UK, we sadly have, not a great history with IPOs. A lot of companies in the UK that do go on to IPO go on to list in the US. We don't have those sort of mega businesses in Europe that can come in and buy a business at a significant valuation. Again, there's no Facebook, there's no Google, there's no Salesforce that has that ability to do that in Europe, as it were. So all of that then happens in the States. But businesses, you don't sell your business, it gets bought.
Yeah.
Right. So if you are at a stage that your business is attractive to an acquirer, then you go through that process. That process may not even work out, but what will happen through that process is there may be another person that comes on. You may make a connection that could be an interesting acquire for your business, etc. And a lot of it happens through serendipity rather than planning. But I think, you know, founders should not obsess over the exit. They should have it at the back of their mind, because yes, that is the goal, the objective that they are potentially aiming towards. But you got to build the business first. Like that's
No, 100%. Okay, I think we've set a record because we haven't spoken about AI in about 40 minutes, and we're both in the startup world, so I think that doesn't happen a lot. But I saw that you had written some Python code. I think it was maybe on a podcast or something that I read. You'd maybe written some Python code using ChatGPT. Do you use kind of any other AI tools kind of in your tech stack now, working in finance, and what would you kind of recommend?
Yeah. So the first thing I would say is AI is not being widely adopted in finance. I mean, there's a lot of people that, and I'll caveat this with a few things, right? So first off the bat, finance is not a game where 70% is okay, right? So if you are building a tool within the strategic finance stack that is only 70, 80, 85% good, you're going to need a human in the loop every time, right? And frankly, you know, I ask this question to my CFOs all the time. Like, they're like, tell me what the cash balance is, tell me what the burn is, I'll figure out the runway, that's it. Like, I don't need AI to tell me that, I'll figure it out. So I think AI in finance still has a ways to go, right? Because, you know, I've tried creating financial models using AI. It's not feasible. You can build a very basic financial model. The reason that Excel and Google Sheets are still ubiquitous is because you can do anything in them, and you can also do your shopping list, right? So I can build a model for a manufacturing business, a SaaS business, a consumer business, a biotech business. Like, I literally, you know, just been fiddling around with a model for one of my clients. And I can do that a hell of a lot easier in Excel or Google Sheets than I can by trying to use AI. So I think finance and AI still has a way to go. I think there are some tools that are at the lower end, the more operational end of the stack, that certainly, you know, AI is obviously valuable, and that's reconciliations. That's, you know, potentially things like chasing for invoices, for argument's sake, or even your kind of bookkeeping, accounting, etc. Right? But within my stack, I use AI for a lot of different things. Right? So obviously, I mean, I spend more of my time on business development than I do on actual CFO work, if I can put it that way. My team does all the CFO work. So I use AI in a variety of ways. So I use it in my day-to-day sort of just, you know, how I think about things. If I want to challenge myself or try and explore the areas that I'm not thinking about, then, you know, I might go onto ChatGPT and say, okay, what am I missing about X, Y, or Z? I use AI for, you know, our contract generation, for our proposal generation, and all of those sort of things. And I use NAN to do that. So for those that haven't used NAN, it's, you know, a no-code platform which you can string together a whole bunch of tools alongside an AI agent or API, and essentially get it to do stuff for you. The other thing I've done is, you know, I subscribe to way too many newsletters, and I read none of them because I just don't have the time. So what I did was I unsubscribed from all the newsletters I was subscribed to, set up a new email address, subscribe to them all there, and then I run that through an and an agent, and every day it sends me essentially a digest, a summary of the newsletters that I've read, and I can obviously go back and then look at those newsletters and read them more in depth. But it gives me the overview that I need to be able to do, not necessarily do, but just to have an understanding of what's been happening, right? So, you know, whether it's the $2 billion that Nvidia has pledged to the UK, whether it's the 100 billion that they've pledged to OpenAI, or whatever else is going on, tariffs, et cetera, right? So, so yeah, I mean, I use AI where I find it useful to use it. I'm not someone who thinks that, you know, everything should just go through an AI machine, because frankly, and you'll know this, I'm sure, every cold email that I get, I can tell whether it's been AI generated or not. I can see the format, I can see the, I can see the tells. I understand what good writing looks like versus bad writing. And I think you become desensitized, right? So you basically start thinking, well, okay, if everyone is using AI, maybe I shouldn't, because in a world of AI, authenticity stands out, I think, more than anything else, right? I've been asked, would I want to turn some of my podcasts into AI generated? And I'm like, well, no, because then it stops being an authentic conversation between two people. I wrote a book, yet to publish it because it's probably going to need a lot of editing. But it's 100 lessons that I've learned in the last 20 years of being a founder, a CFO, CEO, etc. And I get asked, you must have used AI to write it. It's 120,000 words. I said no. So AI maybe provided me some of the scaffolding, like how do I structure a chapter, but all the writing is me, right? Because otherwise, it's not a book that I've written. It's a book that AI has written, right? So yeah, no, look, I think AI has its place. I think we will see more and more applications and usage as it improves. I think on the finance side, it's still not there yet. Like, I mean, there's a meme going around at the moment. AI going to transform finance, the AI, and it's an Excel spreadsheet where it has three numbers, 1, 2, and 3. Sum these, and the answer is 15, right? So, like, if it can't do basic maths, are you going to trust it to, to make sure that your model is accurate? Probably not, right? So, yeah. Love it. I think it's been an absolute transformational tool, but it is just that. It's a tool, right? And I think certainly for strategic level operators, it can't replace strategic thought, because so much of what I do is not a rules-based situation. It's based on my context of having spoken to you, of understanding what the business does, of understanding, whether that product manager is having some problems at home, and that's why maybe they're not delivering to their projects as they should be, et cetera, right? And you can't remove that human element from strategy by just replacing with AI. And let's remember, AI is a prediction machine, right? It is not thinking. It is basically using probability to figure out what the next sentence should say, right? If we're talking about LLMs, certainly. And okay, one could argue that humans are also doing that, but humans are doing that within the context of the 4D world that they're living in, right? So, yeah, I'm a big fan, but I think for finance, it's got a ways to go.
Yeah. If there was one part of the kind of financial workload that you need to do, what do you think there is one area which could most take use of AI in an ideal world? What's one like headache that you have that could be removed?
No, look, I mean, this is a question that we ask ourselves all the time. If you think about strategic finance as being more about the narrative than it is about the numbers, it is how do you construct a story using the numbers, right? And especially your forecast numbers, et cetera, right? So, there are two things. I think it's identifying, it's potentially, especially where you have large amounts of data, it's identifying outliers in the data and what those mean, right? So identification is one thing, but actually then understanding what impact those outliers have, or those trends as they may be. I think that's a potentially powerful use of AI from a time-saving perspective. But again, it comes back to like human in the loop, right? Data without interpretation is meaningless, and interpretation to some extent needs human. You need to be able to ask the right questions, right? So you can present me with a bunch of data and say, tell me what you think, but I need to think through what are the questions that you want me to answer to be able to answer the questions that you haven't asked me to think about, if that makes sense. So I think it is about identifying underlying trends quicker, faster, and hopefully helping you to understand what adjustments you can make, what course corrections you need to make to be able to do them. But I think, in finance more generally, as I say, I haven't yet come across something where I'm sort of sitting there going, okay, well, this is going to replace a huge amount of the cognitive load that I have to deal with.
Yeah. Okay. Amazing. I want to move on to another section now. And you touched on a little bit when you said with your book, you've been doing this for 20 years. What's kind of the hardest conversation you've had to have with a founder?
It depends, right? Like, so I've had conversations with founders where I said, look, this idea isn't gonna, they come to me and they're like, we want to raise 10 million. I'm like, you're not going to raise 10 million. It's not a business that's going to raise 10 million. It's not a tough conversation, but it's an honest one. Probably the hardest, honestly, the hardest thing is where I've had co-founders who have ultimately broken up, right? Especially where I've been very close to one of the founders, and I've had that happen. And before a breakup even looked like it was happening, I just said to him, I think you need to understand whether you're on the same page as your co-founder, because I can see that you're going in two different directions, and that could have significant impact on the business. But no, look, I mean, I'm not there to judge. I'm there to provide advice, guidance, support, and tell the truth, right? And if I think if I think that a founder is acting recklessly or is doing something that is not in the best interest of the business, I'll always call that out. But I don't think I've ever had a difficult conversation with a founder because I approach it from a place of trust and respect.
Okay, nice. And then, so a lot of people say that startups fail because of that co-founder fallout, or maybe they don't find product market fit. But what would you say most startups fail because of?
Lack of cash. Look, I mean that is, I mean, as stupid and as trite as that sounds, that is the reality. With sufficient cash, you can explore the market to your heart's desire. So really, what it is it is when a founder decides that they no longer believe in driving their product or their business forward for whatever reason. So it might be that competitors come on the market and it's blown them away. It may be because they haven't found product market fit. It may be because they don't think they can raise enough capital to keep it going, right? But ultimately, it comes down to that. If the founder gives up, the business is dead. As you mature as a business, yeah, sure, of course, like cash flow implications, all of this sort of stuff. But again, to my point, the founder or the CEO, they need to be able to go out and either raise the capital or, whether that's equity or whether that's non-dilutive capital like financing. It's about whether they believe enough in themselves in the business to keep it going.
Okay, amazing. And if there is founders listening to this when we release this and they're thinking, all right, I definitely need a CFO, obviously, other than coming to you and Emerge One, where should they be going? What should they be looking for in a CFO?
Well, they should only be coming to us for sure. No, look, so what do CFOs do? They work across the capital stack. So that's everything from capital management. So that's runway and burn management, capital allocation. Where do we spend? Why should we spend? What's the ROI? How do we look at treasury? Capital structuring, looking at the debt equity mix. And then capital raising. Once you've decided you need debt, you need equity, how do you raise that? Financial modeling, scenario planning, pitch deck preparation, data rooms, due diligence, all of that sort of stuff, investor relations, etc. And then all the other stuff, KPIs, metrics, board reporting, board management, all of that sort of stuff, right? If you are speaking to someone who purports to be a CFO and they haven't done it before, they're not a CFO. If they haven't, and again, talking very specifically about the world of venture, if they haven't operated in a venture scale business before, do not bring them in, right? Just don't. There have been a ton of people come onto the market in the last couple of years who've sort of seen fractional, especially as this kind of panacea for generating oodles of cash. Simply not true. And a lot of these guys are doing the founders that they work with a disservice because they don't have the experience, they don't have the muscle memory, they don't have the instinct or the knowledge, frankly, to be able to advise and guide a founder in the right way. And we come in often to pick up the pieces when a founder is hired in a CFO. I actually spoke to a founder recently, and they're like, "We've got a CFO, but we wanted to speak to you." I'm like, "Well, if you've got a CFO, why do you want to speak to us?" Well, what they've been doing the bookkeeping, the management accounts, etc. And I'm like, "Well, then they're not a CFO. They're like an accountant. They're a management account, right?" So I think a lot of people make that mistake of conflating the two things. What you want to see ultimately is someone that understands what it means to raise capital and scale a business. And that can only happen if they've had the experience themselves. A lot of the CFOs that we have within the Emerge One team have obviously done that. They've scaled businesses. They've taken them through Series A, Series B, some of them taken them through exits, M&A, etc. But also, a lot of the CFOs that work with us have been founders themselves, right? So they understand what it means intrinsically in their heart, what it means to work with a founder-led venture that is scaling rapidly, right? If you are talking to anyone who hasn't had that experience, you are taking a punt. They are basically asking you to take a punt on them so they can build up their CV. Why would you do that? You have limited resources, you have limited capital, you have limited bandwidth. Go with someone who knows what they're doing. That's the best advice I can give to anyone. And frankly, also understand whether you actually need a CFO or not. I get approached by pre-seed founders all the time, saying, yeah, we've got a CFO, we're looking to hire a CFO. I'm like, you don't need a CFO. The only thing you should be doing at pre-seed is figuring out how to get to product market fit. Like, what is your tech? What is your client base? What is your customer base? What is your go-to-market? How are you going to get there? Like, you don't need a CFO. Use your accountant. Find an advisor, an investor who understands what an Excel spreadsheet looks like and ask them to just give you some advice, right? Like, but do not spend money on a CFO. Why does a CFO, or where does a CFO prove their value? It's when you have capital to manage. If you're pre-seed, you got a couple of $100K in the bank, that is not capital to manage. That is enough money to get you to, a milestone, hopefully, where you can go out and raise some more capital. If anyone is telling you need a CFO at that stage, they are selling you, they are selling you a lemon. So yeah, I mean, but equally, look, and all jokes aside, and I do this for a lot of founders, even if you're unsure, even if you think you have the right person, give me a call. I'm always happy to give you a completely open and honest take on what is right, what is wrong. You and I have had that conversation.
Exactly, yeah.
My job is not to try and sell you our services. My job is to try and make sure that you have the right support for you to grow, whether that's us or someone else.
No. Amazing. Okay. And you've done some angel investing,
A little bit.
I believe. What is it that you look for in a business or a founder when you're making those angel investments?
Firstly, someone who's willing to take really small checks. That's the first thing. No, look, I used to have this kind of thesis where I was looking at multiple things. So did it fit my broader thesis? The things I'm interested in: health, wellness, knowledge economy, and education. Like we're sort of three pillars that I was really am really passionate about, I would say. The second thing is, okay, do I think they can exit? So first question any angel investor asks themselves, is this a market that has substantial value? Or any investor, not even just angel. Is this market something that has substantial value? Do I think this founder could potentially execute? Is there something about the tech that is novel, or the idea that is novel that hopefully will prove that they can they can execute? But ultimately, it's really it is the market there? Is the founder smart, ambitious, capable, can execute, et cetera, et cetera? Because at very early stages, like if you're investing pre-seed, SEIS type checks, like there is nothing else to go on, right? So the heuristics that you're using are very much based on pattern matching about what good looks like for a founder, a market, and a product.
Perfect. Okay. All right. Well, I think that's it. So we can call it a day there. It's been brilliant. I think there's a lot of learnings, from myself and other founders that I think will be watching this. So we've talked a little bit about your business. So where can people find you? How should they get in contact with you if they are going to need a fractional CFO?
Yeah. So the easiest way is to try and connect with me on LinkedIn. Just put a note in, why you're trying to connect. Or you can go to our website, www.emerge1.co.uk. We have a contact form on there. Or you can email us at hello@emerge1.co.uk. That's EMERGEONE.co.uk. But, I'm there on LinkedIn. I'm there on Twitter. I'm sure you can find a way to get in touch.
Perfect. Well, thank you very much for your time today.
Amazing. Really appreciate it. Thanks.